What's up guys and welcome back to the channel. So today I want to talk about Nio stock. It has been a huge week for Nio. After dropping to the lowest share price in nearly 2 years, Nio have just released their Q4 and full year 2021 earnings report. But then on Friday came a very surprising development. Cathie Wood of ARK Invest decided to dump shares of Tesla and open a position in Nio stock. With this development I am left wondering why now? Why has Cathie Wood decided to buy Nio stock right now? So in this video I will look at the reasons for this and the reasons for the share price dropping this week. We have new analyst price targets too, which I will look at later on, and I will look at the charts to assess what is happening and what is going to happen going forward. If you like this content, can you smash the like button? It literally costs you nothing, but it helps me out so much and it shows me that you want to see me create more Nio related content. As always, this is not financial advice and I'm not a financial advisor, but if you do enjoy this content or find any value in this video, show your support for the channel, smash the like button and hit that subscribe button. Now let's get into it with the very latest news. Cathie Wood trims $147 million from Tesla stake and initiates position in Nio. This is the first time that ARK Invest has bought into Nio stock, and although ARK has built significant stake in Tesla, in recent months ARK has been piling up shares in Nio's Chinese rivals Xpeng and BID. As we can see here from Friday's ARK Invest trading information, Cathie sold off a big chunk of Tesla stocks from three of her ETFs. Now this is likely due to the fact that Tesla has just went above $1,000 per share for the first time since January, and the fact that Tesla is up over 30% in the last 2 weeks. But with this freed up cash, Cathie has added to her bid position with 80,000 shares and 600,000 shares of Roblox, which is huge. But then, for the very first time, ARK have bought a sizable chunk of Nio stock for the ARKQ fund to the amount of 420,000 shares, which is about $8.5 million of Nio stock. So this is a very interesting development for ARK Invest. If you follow ARK or subscribe to the daily trade information like I do, then you will know that during the second half of 2021, Cathie began a huge sell-off of ARK's Chinese stocks. However, over the past few months, Cathie has been heavily buying the dip on Chinese EVs. As we can see here, ARK has been buying up Xpeng stock since December, and it's the same with BidCo, who are also backed by Warren Buffett's Berkshire Hathaway. Now ARK holds about 900,000 shares of Xpeng, about 410,000 shares of BID Limited, and now they have 420,000 shares of Nio too. So it will be very interesting to see how much Nio stock Cathie will buy over the coming weeks. But the question is, why is Cathie Wood buying Nio stock now? Nio stock has dropped to its lowest price since mid-2020, and there is a number of reasons for this which I will look at. But the fact remains that this is a very different company than it was back then. 2020 was the year that seen Nio avoid bankruptcy and begin to scale up production and sales, but the sales for the whole of 2020 was just 43,000. Sales last year was much closer to 100,000, and then there has been partnerships as well as vast expansion. In fact, back in February 2021, Cathie Wood referred to Nio as a battery swapping company that will win the day in China. So although Cathie Wood rarely talks about Nio, she has clearly been keeping an eye on this stock over the past few years. But on Thursday, Nio released their full year 2021 annual report, and although met expectations regarding deliveries and revenues, the company missed on overall net loss and EPS, falling well short of analyst estimates. This coupled with the fact that earlier in the week, analysts, China Renaissance Securities and Morgan Stanley had set low price targets in the mid to low $30 range. Morgan Stanley in particular slashed its price target by nearly 50%, down from $66 to just $34. But it's worth remembering that the current price is only $19, so even these low price targets are still nearly 100% upside from the current price. Now I'm sure that at this point most of you have already seen the annual report, so I will just go over this briefly and then discuss the impact of some of the main concerns. Looking at Nio's income statement, we can see that the company has total revenue of 9.9 billion yen, which is about $1.5 billion US dollars. This is about 50% increase year over year, so that is good, but we should probably be expecting more, to be honest. And then there is an overall net loss of 2.1 billion, which is about $336 million for the year. Again, this is about a 50% year-over-year increase. But a company's health is not measured by its income statement, so let's look at the balance sheet. Nio has total assets of 13 billion and total liabilities of 7 billion. This is a strong balance sheet for a company that is making this kind of losses. The cash figure of only $2.4 billion does concern me. Nio had more than 2 times this amount of cash on hand at December 2020. However, that being said, the balance sheet is a bit stronger now than it was in 2020, with total assets of 82 billion yen versus 54 billion in 2020. But the main talking point from this report was not the financials. Nio stock tanked by 10% on Friday, mainly due to Nio's Q1 2022 delivery forecast, which was considered weak. Nio delivered a total of just 15,783 vehicles in the 2 months so far. It is expected for a strong rebound in March regarding delivery volume for Nio and a return to delivering about 10,000 EVs a month. It is also important to highlight that delivery volumes in January and February dropped off for all Chinese EV manufacturers, not just for Nio. Nio could still achieve up to 190,000 EV deliveries in the full year 2022 as new models launch. Now, this is an extract from an article over on Seeking Alpha written by the Asian investor, and it is well worth a read, so there is a link to this in the description for anyone who wants to have a read of this full article. Commercial results, including higher vehicle margins, indicate strong business momentum. Nio's stock price has not shown lately that Nio's business is going well, but it really is. Vehicle sales surged 49% year over year. What is especially impressive is that despite Nio's production problems, vehicle margins are increasing rapidly. In Q4 2021, Nio's vehicle margins increased to 20.9%, meaning Nio is becoming more profitable on a per unit production basis. While Nio is still generating losses, EV Startup is making significant progress and moving towards profitability in 2023. And Nio has become significantly undervalued. Nio has become too cheap, I believe, and the stock continues to represent deep value at a price to sales ratio of just 2x, especially considering that Nio traded at much higher market cap to sales ratios in 2021. As the firm launches new models, Nio is facing some promising catalysts that could drive the share price higher as well. Risks with Nio. Nio has short-term timeline and production risks. Computer chip supply issues affected factory output in the global auto industry in 2021, and they are still a risk for Nio and other EV manufacturers. Nio lowered its delivery forecast in 2021 due to the strained semiconductor supply situation, but this is not the only risk that applies to Nio right now, which I will look at in just a moment, so stick around for that after I look at the charts first. And the author's final thoughts I fully agree with. The risk reward looks extremely attractive here for Nio. The market seemed to overreact to the company's production guidance and supply chain issues, and the resulting 10% drop is not deserved. Looking at the charts, we can see that the stock has been dropping steady since going over $50 back in July 2021. And looking closer since the beginning of the year, Nio has been on a steady downward trend, moving from $33 on January 4th down to as low as less than $14 earlier in March. But I do feel that this is too low for a company of this size. But as I have said, there are some risks involved with Nio. First of all, as I talked about in the financials, Nio has got just 2.4 billion in cash. For a lot of companies, this would be loads, but in the EV industry, this might not be enough. And this does come after recently raising $2 billion near the end of 2021. Macroaccess.com rates the chance of financial distress at Nio to be over 96%. Now, this is very high, and although I do not know how this has been calculated, I assume this is by looking at the company's balance sheet, the income statement, and the company's cash flows. And although I don't think that Nio is in any immediate risk, this is something that does need to show signs of improvements in the coming months. The other concern is this: the US is moving closer to delisting Chinese firms. Now, this article was written on Friday, so this is not me dragging up some old crap trying to spread FUD. Actually, it's quite the opposite. Look at this. How soon could Chinese companies be delisted? Nothing is going to happen this year or even in 2023, which explains why markets initially took possibility in stride. Under the HFCAA, a company would be delisted only after 3 consecutive years of non-compliance with audit inspections. So this does not affect Nio, and I've spoken about this in previous videos. However, things change so quickly sometimes regarding China, so this is something that all investors really need to be aware of. So that is my analysis of what I think. But what do you think of Nio stock right now? And where do you think the share price will be in the coming months or in the next 5 years? Drop me a comment and let me know, what are your plans for this stock? Are you buying, holding, or selling? And if you enjoyed this video, make sure to smash the thumbs up and subscribe to the channel if you're new, and have a blessed day.